making sense of macro, and I've added there in brackets when nothing seems to make sense. So this is basically a rerun of the webinar that I did yesterday with Refinitiv, and so what I'm going to do here is take you through my research framework, talk a little bit how I approach markets just to give a bit of context that'll make the charts make a bit more sense when we come to them. Then we're going to go through the core views and the investment implication of those core views, so the asset allocation views around that. So research process and framework. So at a highest possible level, what I try to do is bring in as many sources of information as possible. It's very much a quantitative based process, but not a quant process. So starting with quant, like being very data driven, chart focused, but having that judgment overlay to tie it together. And so what that means is starting with valuation. Like basically my process is anchored in valuation, and that means figuring out what actually is the right indicator to use for making valuation judgments, and then also figuring out what kind of weight to give that valuation signal at various stages of the cycle. So for example, earlier in the cycle when valuations are at extremes, or at the end of the cycle when valuations are extremes to the top side, that is a much stronger signal than if valuations were sort of middle of the road. But you can't just base investing on valuation. Certainly if you have some sort of awareness of shorter term performance, you need to be bringing in these other factors, so cycle, tactics. Cycle is things like earnings cycle, economic cycle, supply cycle, really depends on the asset class. And then also cycle covers monetary policy, monetary conditions, critically important stuff there as well. And then tactics are about rounding out that sort of core thesis that develops out of those two previous factors. So tactics is sentiment, flows, positioning, and sensible technical analysis techniques. And so just briefly on key beliefs to sort of tie this all together. Risk equals owning an asset which is overvalued, so back to that valuation stuff. Overowned, so that's sentiment, positioning. Overbought, technicals. Out of time would be, if monetary policy had been significantly tightening and economic data had been rolling over from strong levels. So, and then risks also the opposite of that, being underexposed to assets which are undervalued, unloved, oversold, and turning around. So really that's it at a high level, and then as we get into this, that's going to make a lot more sense. And just briefly, in terms of the key objectives and scope of my research, the scope is global multi-asset, so you can see the investment universe there, just equities, alternatives, fixed income, everything under the global multi-asset sun. And objectives are risk management input, coming up with ideas, and helping clients gain perspective. Speaking of which, let's get into the core views. So I'm not going to go through each of these on this slide because we're going to actually build this up as we go. We might come back to this at the end. So probably the number one thing here is the whole idea or theme or really tension of stimulus versus social distancing. Now I think there is a fair amount of debate, and it's probably sensible debate, understandable debate around, whether the stimulus is enough, whether it's, going to work, whether it's actually even the right thing to do in the first place. But one thing that is quite grounded in fact, and that we probably have less debate on, is just the historic nature of it. Historic in terms of the magnitude, historic in terms of the coordination across countries, coordination between fiscal and monetary, and also the speed. In past cycles, or the usual playbook is that central bankers will sort of hum and ha and twiddle their thumbs for a bit, wait for the data to show up, manage expectations, all the rest of it. But this time around, it's been, and frankly, just because it's more of a shock, they have actually been more rapid in their deployment of the stimulus. And you can see that there in the chart to the right here. So it's the red line there is global central bank balance sheet expansion, the big three G3 central banks. And you can see there it's just been massive, rapid deployment of monetary policy. And back to that sort of quip there, stimulus versus social distancing, this really helps understand the flow of market action over the last couple of months. So that big rebound was in response to that massive wall of liquidity, or that tidal wave of liquidity washing across the world, washing away the worst fears at least. But then, the social distancing side of things are actually bad. Like there is actual, a lot of major economies are effectively shut down for all intents and purposes. So that limits things to the top side. And so you have this tension that's continuing to play out. And yeah, just to illustrate the shock to the system, you can see the global manufacturing PMI on the chart to the left there, gone off the scales. Further out, my view is that when the economy opens up again, things will get back to business, there'll be pent-up demand, but there will also be a massive amount of stimulus in the system that is building up, as we can see on both of these charts. But in the meantime, it's going to be more of deflation, downgrades, and doom. So the data flow for probably the next couple of months at least is just going to be that, what I said there. And then the chart to the left there really illustrates it really well, I think. It shows the proportion of countries who are seeing basically deflation or quote unquote deflation, so negative annual CPI inflation in the red there. You can see that there was actually a bit of an uptrend in deflation last year as we had that export manufacturing recession last year. But then, of course, with what's been going on in commodities and also what's been going on in the economy, we have had this sort of deflationary wave spreading across the world, not just in price inflation, but economic deflation in terms of forward earnings, industrial production as well. And what I think this is going to end up doing is really anchoring and shifting expectations. We kind of go through this cycle of resets and expectations. And no doubt with all this deflation data and doom in the headlines and the data, we're probably going to start seeing narratives start to shift. A lot of commentators like to focus on the current, the near and pressing, in terms of how they construct their narrative. So we'll probably start to see thought pieces on structural deflation, the new normal of deflation, and all the rest of it. So and to me that is one of the best things about using charts like this, is because it helps you identify opportunities that come out of shifts in emotion, shifts in thinking, shifts in expectations. Because I believe, and I've been putting a lot of thought into it, I believe that we do see a significant snapback when things get back to business. I mean, I would note that I would concede on the stimulus front that the transmission channels are shut down at the moment, so cheap fuel costs don't really matter if nobody's driving. So that is we do actually need to see the economy open back up for that kind of stimulus, or that aspect of stimulus to flow through. Certainly also in terms of borrowing costs, mortgage rates. People can't take advantage of cheap mortgage rates if the loan officers aren't at the banks approving loans, and if people aren't out buying houses. Anecdotally, over here in New Zealand, we've gone from very tight lockdown to very much a lot easier conditions now. And our daily virus count's gone basically to zero. I don't think we've had any cases for a couple of days now, which is quite good. And my family, they work in real estate, and they've seen massive snapback in activity there. They're the busiest they've been in years, so that's probably a good sort of conceptual analogue of what may be to come elsewhere around the world. So yeah, I mean, that's my base case, global rebound as economies, but it's going to be probably not global as such, is going to be rolling. And one sort of way to illustrate that is this chart on the left here. So in the sort of overall umbrella of where to look for green shoots. So the chart to the left here is what I've done is taken the average of countries whose Refinitiv Ipsos Consumer Sentiment Index has started to recover in the black line, so whose May reading, so this is updated to May, whose May reading is higher than the minimum of the last few months, and whereas the blue line is those who made a new low in the May month data. So, and you can see there, I mean, it's basically those who are early recovered and those who are still falling. If you look across the countries there, some of the ones who are recovering are the ones that either got the virus earlier in the process or who took more unified and stricter measures against it to contain it, and the other ones are those who have been struggling a bit. So, I mean, this one is quite interesting. It speaks to sort of, a different pace of recovery. I think, the idea of a synchronized recovery probably won't come into play until everybody's sort of on the same page, everybody's opening up, and and until then it's probably going to be some interesting relative opportunities coming out of that. But in terms of green shoots, where to look for the data, where to look for signs of green shoots, ignore GDP data, ignore most of the hard data. Those data come out with too much of a lag and is very much backward looking. You want to be looking at things like these consumer sentiment survey data that I've just talked about, the market PMIs, earnings revisions ratio, and even relative performance of the corona trades, so airlines, hotels, malls, retail, etc., versus online retail, esports, healthcare, things that have gained from this. And also, it can get a little bit circular, but tracking price performance across bonds, commodities, stock markets will tell you at least a bit about sentiment and also reflect the evolving fundamental picture as it gets priced in. So in terms of the so what, so we'll start moving into the market views now. At a high level, basically bullish global equities, raised bullishness actually back in March, and the reason for that was just this big reset in valuations. So EM actually briefly got to the lowest, or the cheapest valuation since the start of that big EM bull market back in 2003, and developed markets ex-US also making very significant lows there back to 2009 levels briefly, and even though they've rebounded, they're still looking very cheap. US is a slightly different story. It went from very expensive to not so expensive, so there's definitely a relative value play there, or relative value story there, which is probably too big a story to cover in this video, but just briefly on the PE10, so I'm using here price versus trailing 10-year average earnings. That, in my view, is the right valuation metric to use. If you use forward PE, you're just going to get all sorts of weird haywire signals. It's just not going to tell you anything useful. You need to have a normalized picture of or a steady anchor, because forward earnings are just they're going to absolutely collapse, and then they're going to snap back. Really, the only reason you would use forward earnings in a valuation ratio to give you your valuation read would be that if you believe that where forward earnings are now is representative of where they'll be for the foreseeable future, i.e. you don't expect a recovery. And you have to, I can probably put together a scenario for that, but you'd have to believe some pretty extreme things, and you'd have to ignore a lot of history for that to actually take hold. But moving on, equity risk premium, that's basically just conditioning these PE absolute valuations against bond yields, but I'll talk a little bit more about relative value against bonds in a couple of slides ahead. So valuation picture, much improved. It was way better in March. It was some, really compelling cheap valuations back in March, but still good now. But positioning is quite interesting. Whether you look at positioning data, surveyed sentiment, flows, anecdotes, investor sentiment is still quite negative, still quite pessimistic, quite defensive. very lightly positioned. So if you look here, American Association of Individual Investors survey shows surveyed allocation still very much below long-term average, much lighter than usual, much lighter than the last 10 years, that's for sure. And then you look at the State Street Investor Confidence Index on the right there. That is State Street. They use their global custodian business to track where institutional investors are positioned. And you can see that they've lightened up positioning quite significantly there. And that lines up with other things like BAML survey, Centex surveys, and all that sort of thing. And so to tie that all together and going back to that idea of that research framework, starting with valuations look good in both in terms, certainly I would say at a global level, particularly so for global ex-US. So valuation looks good. Sentiment, positioning, quite pessimistic, quite light, which is a good thing from a contrarian standpoint. Monetary policy, massive tailwind there, both in terms of liquidity and future growth expectations. But, economic data would be the one question, but the way that you read cycle data, so let's just step back, we'll ignore the current situation. Conceptually, the way you read cycle data in making medium-term asset allocation decisions for equities is that actually when the data is bad is typically the best time for buying. Ideally, you'd want to see the data get really bad and then turn up, start to stabilize. But, typically if you look back through history, you tend to get better results from the long side when the data is crappy versus when it is the best ever. I mean, the worst thing from a bullish standpoint on equities would be you see really good data start to roll over. The best thing is you see really bad data start to turn up, which would have been preceded by some sort of stimulus probably, which is basically the case now. So yeah, that's my view there. And then just finishing off with bonds. I've got a couple of slides on commodities, US dollar, but we'll just stick to equities and bonds for now. So bonds, it's coming back to that relative value aspect there. You look at treasuries. My valuation indicators for treasuries show them more than 2 standard deviations expensive. Basically about as expensive as they've ever been. And then you look at growth assets, so international equities, US equities, commodities combined, and it's almost 1 standard deviation cheap versus long-term average. And so you look at the spread there, and that really says a lot for the medium-term perspective, the medium to longer-term perspective. Shorter term is anyone's guess. Shorter term, I would say, just briefly, to get another leg down in equities, you do really need to see some new bad news, something to jar the market out of that tension or that balance, I guess you could even say, between stimulus and social distancing. But further out, this chart is going to dictate, price paid dictates a lot when you're talking about medium to longer term returns. So, in terms of asset allocation, active asset allocation, that chart there is pretty much your North Star, pretty much your guiding compass. I mean, to be having a meaningful allocation to treasuries versus growth assets at this point in the face of a chart like that, you'd have to believe some pretty, I would say, interesting, quote unquote, to use a euphemism, things. But just lastly on bonds, this chart on the right there I think is quite interesting too, and also speaks to what I talked about back on that first slide. So what we've got on the red line there is developed markets manufacturing PMI. No surprises there that it's plunged. But interesting is how the US 10-year government bond yield, it followed it down some of the way, basically saying, yep, we get that things are bad, they're not what they were, but we're not going to follow the PMI all the way down. And to me, that says the bond market is, you know, similar to the equity market, looking through some of the worst of this, some of the shock element of it. Um, I would say the bond market is not yet looking through to the extent that it's, looking all the way through and seeing some sort of growth, inflation rebound, but that's kind of a little bit outside of the visible horizon for now. So, I mean, that's pretty much sort of a key chart there, really, in squaring up the data versus the market. So I'll leave you there, and we'll just jump back to the core views there. So stimulus versus social distancing. It's the tension between stimulus and the bad stuff. Deflation and downgrades and doom. Probably going to see more of that in the meantime, but further out, we're going to see a big rebound. Global equities look good. Global bonds do not. So that's it. So this presentation is actually extracted from the quarterly slide deck that I do, the quarterly strategy pack. If you wanted to take a look at that, or if you wanted to take a look at our services in general, I basically only work with institutional investors though, so just what's a point to keep in mind. So yeah, if you're an active asset allocator, a portfolio manager, and you want to check out the rest of the stuff that I'm working on, definitely get in touch and I'll get you set up with a trial.